Welcome to Gray to Great, the podcast where we will pull back the curtain on what it truly takes to thrive as a corporate retirement plan advisor in today's tech-powered business world. I'm Dan Dal Degan, but all my friends call me Triple D. As a former sales leader and CEO and now board member of the parent holding company of the Great Gray Trust Company, I know that success in this field goes beyond the numbers. In each episode, I'm going to team up with one of your peer retirement plan advisors to bring you the strategies that separate the best from the rest. From prospecting and referral business to challenger selling and tech adoption, we're diving deep into the parts of the business that too many of us overlook. Whether you're here to sharpen your skills or if you're looking for the next big idea, this is where the playbook gets rewritten. So get ready for sharp, actionable insights that'll take your practice to the next level. Because in sales, there's no gray area. Hello and welcome to another episode of Gray to Great. I'm Dan Dal Degan, your host, and I'm joined this time with two guests. We have a twofer today and a really rich conversation in context and utility, I believe, for our audience of financial and retirement plan advisors. I'm joined by Charlotte Hickey, who's the Director of National Accounts for BlackRock, and I'm also joined by Zach Rosenoff, who's the Director of Investments for the Marsh McLennan Agency. Welcome, Charlotte and Zach. Great to have you on.
Thanks for having us.
All right.
Dan.
Well, yes, thank you for being here. This is the first time we've had two guests on the podcast, and we've got a very deep, broad topic that I think is rich in opportunity for our viewers to get some great perspective that's very actionable for them in their practices. And we'll jump right in. And as we talked about a little bit, as we always do as a precursor to these conversations, we'll get together with guests and riff a bit on, well, what would be a really compelling discussion area for our viewers? And we hit right away on something that's current in the political and legal landscape, and that is some legislation that has an executive order about the democratization of access to private investments. And it does introduce the concept, which we live with every day and these days globally, not just in the United States, of topics getting politicized and trying to get to some meaningful conversation with, in this case, our clients, plan sponsors, plan participants, without politicizing the topics or trying to bias the audience for or against on the basis of what was the origin story, like in this case with an executive order. So Zach, let's start with you. I'd love to hear, how do you navigate those sometimes choppy waters to focus on the issues that really matter for your clients?
Yeah, and I feel like today is kind of an extreme side in that you have extreme views on both sides. So it kind of leads to very polarizing topics. And I would say kind of the recent example was the ESG narrative that came out a couple years ago, where you had all these conversations that you just had preconceived notions kind of dominate what people wanted to talk about. And you never ended up even getting to the productive part of the conversation. So I think it's like obviously and kind of important to just know your audience at the outset. So like kind of having some background on what the room you're going into and kind of what some of their preconceived notions may be. But specifically for this topic, I'll be honest, I think it was a little bit surprising to me that it was even perceived as being as politicized as it is. Like if you just asked me as like an investment analyst what we're talking about like expanding the opportunity set of eligible investments in diversified portfolios. Like that's objectively a good thing. I think you have to kind of look at it from that viewpoint, but specifically when we're talking about political views, I would say like knowing your audience is one, but then when you actually have the conversation with clients, I think you have to break it down as simply as possible of like, what does this mean and what doesn't it mean? So to me, what does it mean? And this is kind of in the executive order. It like the line is every American preparing for retirement should have access to funds that include investments in alternative assets when fiduciary determines it's appropriate. It also defines what alternative assets are. So private credit, private equity, commodities, infrastructure, digital assets and crypto is in there. Lifetime income is in there. So it tells you what is kind of falling underneath that moniker of alternatives. And then the Trump administration has tasked the Department of Labor with providing guidance. So they basically started the gun. They're starting the clock. They've now opened the door for additional regulation. That's basically what it says. It doesn't. So what doesn't it say? It doesn't provide regulatory clarity or guidance on how fiduciaries should be able to consider that. That's something that we're going to need to wait for the DOL to provide clarity on. It also doesn't mean like Melania coin is coming to every 401k lineup, right? It's talking
Right.
specifically about specific sleeves of alternatives within other investments like target date funds, managed accounts, balance funds. So I think once you kind of take the approach of like, this is what it says, this is I think the initial intention of the document versus what it doesn't say is important. So you can kind of get right off the front and kind of steer the conversation and say like, you want to try to eliminate the tails of extremes on both sides.
Yeah, I love that. Eliminating the tails of extremes on both sides. Boy, wouldn't we love to do that in every conversation that could get politicized these days, right? And hopefully we return to that where there's a meeting in center where we can have some meaningful depth of conversation and inspire and influence each other and actually inform each other about another point of view. What often comes with that is new terminology. So when you have access to private investments for plan participants and sponsors, there's probably a new vernacular that you're asking them to get familiar with. How do you help your clients navigate that?
So that's kind of the critically difficult piece, I would say. And even for the new vernacular for the like private markets in 401ks, even I have to kind of relearn some of these things. Like it's one thing to kind of learn them in a textbook setting and kind of like reading through what falls under private equity and things like the J curve and intervals and kind of different private equity characteristics versus like talking to a plan sponsor. I think you first need to have a very clean, succinct understanding of what these products are to be able to explain to like my peers. So other of the investment analysts on our team, like, can we have a well thought out kind of conversation on what is going to be potentially included in these, and then be able to simplify and bring it down to clients? And I'll be honest, I don't know that we're even at that point yet. I think that's what takes time to kind of work through. So whenever you frame these conversations, I think it takes multiple quarters or multiple meetings to be able to be like, hey, this is the topic that we're talking about, kind of the what does it say, what doesn't it say? And then it's kind of gauging interest and saying like, oh, remember when we kind of talked about this executive order, here's what was in it, here's the current state. So now we have some target date funds with an embedded sleeve. You kind of show them like, remember your current target date fund, this is what it does. Okay, here's the target date plus version, this is what it potentially would look like as these products continue to evolve and such. So I think you kind of have to lean on what is like the existing knowledge. Like we've obviously built the trust and relationship with a client over multiple quarters, over multiple years in some cases, and you kind of have to take what they already know and then just build on it incrementally, recognizing that it's going to be kind of a slow iterative process.
Right. And that taking
Thanks
stock of
for
what they already
Zach's.
know is it. Oh, I'm sorry. Go ahead, Charlotte. Please. What's your
I
thought
just
on
wanted
this?
to add, I think Zach bringing up target date funds specifically, I think is really, really important because they can be that entry point that advisors are already very familiar with. And target date funds specifically with very purpose-built private markets exposures, they can help increase returns while addressing a lot of the real concerns that plan sponsors and their advisors have around liquidity, transparency, and expenses. All this is a lot easier to do in a target date fund package that already includes liquidity and public markets exposure than a single box offering. So wanted to double click on what Zach said as target date funds specifically being a little bit easier for that first entry point.
Yes, thank you for that, Charlotte, and also thank you for allowing me to avoid having to look up again. What does TDF stand for again? Speaking of new vocabulary, right? So, and in that world, as a plan participant, I'm as much a neophyte as any newcomer you would encounter as an employee of one of the companies who you serve. How do you take stock for participants and plan sponsors of what they know already, so that you know what foundation you're building on when you're introducing new themes, new concepts, especially with the introduction of private investments? And how do you do that in a way that doesn't come across as condescending or overly elementary in the way you explain it?
Yeah, I think you kind of have to build it into like the way you have some of these client meetings. So there's two different pieces, right? We're talking about the client facing component, not the internal component. I think internally it's a lot easier to have these conversations because you can kind of challenge each other, you can get in the weeds, you can put a lot of statistics and data behind it. You don't have to worry about kind of stepping on landmines. I think within the client, the history you have with the client, you kind of know the key decision makers, you know the makeup of a committee, you know what their kind of prior interests are. Like, have they engaged in the lifetime income conversation that we had 2 years ago? Like, if they were completely dismissive and it was like, oh yeah, well, bring it back up in a couple of years, then you know what, maybe it's just not something that's in their immediate kind of line of sight. So you kind of have to take it case by case and bring the prior history into the conversations. I think you also kind of have to weigh this trade-off between like enthusiasm and skepticism, where some clients are going to be like, oh, this is a new topic, like we want to hear more about it, like even if they don't feel like implementing. Some people just want to learn more. So if they're on the enthusiastic side, you can go a little bit further in the weeds and be like, this is a new product, here's what's good about it, here's what's bad. Then you have the skeptics who are like, we would like, some, I know this may be, kind of sacrilegious to say on this podcast, we have some clients that aren't comfortable with CITs, right? That doesn't mean like we as advisors aren't comfortable with them, but we have the spectrum of people that are kind of skeptical versus enthusiastic. You have to know what their background is and kind of aim towards that, but try to kind of bring them closer to the middle on either side.
Yep, that makes perfect sense. And Charlotte, I'd love to hear your perspective on this too, because it reminds us that in client-facing professions, whether you're in financial services or like where I spent my career in software, you're in healthcare, manufacturing, knowing people and knowing how to read people, and are they getting it? Are they buying into it? Is there some anxiety? Their body language, their nonverbal communication. As you've navigated your career, how have you mastered those things? Charlotte, I'd love to hear from you on that.
Sure. Well, I think one of my favorite parts about working in retirement specifically is that our space is so bipartisan at its core. So when the room is divided and if the path forward is unclear, then I think it's always helpful to reframe and reset and agree on a common ground, even if it's going back to the basics of just expanding access and boosting savings and being very, very focused on participant outcomes, which I think is the number one thing that we should all be focused on.
Yeah, that makes perfect sense. And on that topic, when you're showing somebody a model, the data could be really strong and accurate and you could believe wholly in it. But if the model is unfamiliar to the audience, how do you reconcile that and get them comfortable with speaking a new language and looking at this through a different lens?
Yeah, and something that I think is specific to this space is that the model is not new. So DB pension plans have been investing in private assets for decades, on average about 20% of their assets. And I strongly believe that this opportunity should also be available to DC plans. And our research at BlackRock shows that thoughtful structuring, again, very deliberate strategic allocation to private assets alongside public, just as a target date fund, as we talked about, could increase returns by 50 basis points each year. And over a participant's entire working life, that's about 15% more money in a 401k. That's a very, very real outcome. So I think always focusing on the data and highlighting previous client examples, as I mentioned in the pension space, can be really helpful for these initial conversations.
And I'll just kind of add on to that, because I think this is where it gets into the side. Like, obviously, when you look at kind of the modeling of these products, like if you're putting in kind of these volatility smooth vehicles into a portfolio, it's going to improve outcomes like 100% of the time, right? The term that I was seeing on CNBC is called volatility laundering, right? So if you put in like enough of these vehicles that don't have the actual reported volatility, like, yeah, it's going to kind of increase the expected return and obviously going to lead to more benefits. Like, the example I would use is one of the new terms I've had to learn is semi-liquid evergreen structure. Like, I didn't know what that was until like 2 weeks ago. It's not as complicated as it sounds, but it is a new terminology for me. So basically what these are is they're kind of like the transition of private equity or private credit into a new structure that doesn't have vintages. It's kind of this ongoing structure where it's like funded with regular cash flows and there's quarterly redemptions. Like, that's the simplest form of that. There was a Morningstar report that showed like the performance of semi-liquid funds through April of 2025, right? So Liberation Day. Unsurprisingly, the S&P had a pretty significant drawdown. Semi-liquid funds didn't move very much. It's because they're not really reported. So it doesn't track the prices of daily mark-to-market prices, right? So I think you kind of have to like look and be just conscious of what the actual data is showing. But to Charlotte's point, like, the idea of alternatives in investment portfolios is not new at all. It's just transitioning into our space. So I think you have to be diligent and kind of responsible about how we look at that. And I would point to, from a data standpoint, like, these products, you have history in other vehicles. In target date funds, these products are kind of just now brought to market. So we're going to start getting data from this point going forward, which is objectively a good thing. Like I do believe that alternatives kind of improves, like having a bigger opportunity set for a diversified portfolio is a good thing. Right. So it's now trying to figure out where that line is of what we're actually putting into these products, kind of how far that needle is. Like to Charlotte's point, is that 50 basis points? Is it durable? Is that enough to justify the kind of complexity and fee structure? The market's going to kind of tell you that, but I think until we need to get some kind of like live real money numbers in these products, and that's just part of kind of furthering the conversation. So I do think you can be like, I would count myself as somewhat skeptical, but obviously very optimistic on what these are, because I do believe in the long-term characteristics of offering these within a balanced portfolio.
And that makes the conversation for me, as the probably typical plan participant, a much more approachable one and less intimidating, especially when you're offering your perspective and your experience. So to that end, and Charlotte, I'd love to hear your perspective on this. When you see a model or you see a view that a model is depicting, or an investment alternative where you think the picture is overly rosy, what are you looking for to try to offer a healthy and useful perspective to your client?
Sure. So alternatives is a space where it is especially essential to work with an expert. This space is very inequitable, but innovation is also never easy, right? It's usually slow, and we work in an extremely litigious environment. I think a lot of us have heard the stat that half of large market plans will be sued for alleged excessive fees. And ERISA historically has been very process driven and not performance driven. So I think as an industry, we have to think about what we should be focusing on. Is it avoiding litigation, or is it performance and improving participant outcomes?
Yes.
I'll,
Just
I'll,
both, but yes,
yeah.
the latter probably promotes the former, I imagine, right?
And I would say this, I think process, like obviously from fiduciary standpoint matters, but even process within the alternative sleeve, like we're coming from an environment where we have basically vanilla target date funds, then you have maybe a sleeve of commodities. Like we're talking about kind of like cryptocurrencies as part of this legislation, right? So there's this whole range of potential solutions that could be included in this. We're not saying they're all going to be included, but I think you have to take like a very micro view on some of these and separate like, okay, does this specific sleeve of alternative make sense in this portfolio, and kind of how can you point to that?
And how do you decide that, Zach? Like if there's some inherent complexity and definitely new conversations about, in this case, crypto, how do you decide when something is ready enough to bring to a client where you can work it out in the conversation?
So I think like I said, I think being data oriented naturally as an analyst, like we all want to be able to point to and say, like, for example, here is a baseline target date fund, here's a target date plus fund, and here's how it did relative to a very similar type of construction, right? You kind of have to have, or it'd be nice to have some sort of relevant benchmark for these products, but understanding that that may be a little bit down the line. So I don't think you want to go so far as to say, oh, we have to wait 5 years for all of these things. Like we need to see explicitly how this works. Then you get the risk of kind of being caught behind the ball. We can kind of talk about that later as well. But I think having some form of actual live money data, not just hypothetical back testing data, is important. I also think that especially for these types of products where we're getting into this semi-liquid component. And I'd like to talk about this too, but like within targeted funds, the liquidity piece is a lot easier because you can source it from the rest of the portfolio. So I think that's a really important piece. But no matter what, scale really matters for these types of products. Like if you're going to have any sleeve, even if it's 10%, that is not as liquid as public securities, that means $100 million is not enough to fund it, right? Like it has to be significantly larger in an asset base. So until you get to that point, like we would not, like, I don't think you want to be tip of the spear and kind of on the smaller end when there's not like a diverse set of clients in these products, when the actual total assets isn't big enough. So I think some form of kind of relevant benchmarking data and then some form of scale is pretty important to be able to get comfortable. That said,
it makes sense. Thank you for that. And it's a bit like not buying the first model year of a brand new car. Right? Let's get some volume and some case history. Charlotte, you made a really compelling comment as well earlier, talking about the difference between, optionality and outcomes. And it seems like, what I've learned in my very steep learning curve here on the retirement plan community, at conferences and conversations like this on this podcast, it seems like there's been a focus traditionally, understandably, on menus, on a list of options, on optionality. And now we're shifting the conversation to outcomes, which seems like a natural place for a discussion with a plan, sponsor, or participant to become. What's your perspective on that transition?
I think it's very, very welcomed. And thinking about participant outcomes as our kind of North Star, we at BlackRock, again, think about incorporating only deliberate private asset allocations to a professionally managed vehicle like a target date fund to help our clients capture that opportunity that we see in private markets. Knowing that over 80% of companies with revenue over 100 million are private, companies are staying private longer, you're just missing out if you don't have access to them. I'd also add that the alternative market in general is just becoming less alternative and it's growing rapidly. We're at about 13 trillion today, estimated to be at about 20 trillion by 2030. And this is all happening while public markets are shrinking. Looking ahead to the future, I think the portfolio is also going to really change. So no longer 60-40, rather looking more like 50-30 and then maybe 20 in private markets. Would be remiss if we didn't also highlight some of the research that we've been doing at BlackRock. We just came out with a new white paper that covers the work and research that we've conducted for target date funds, completely agreeing with Zach's point. We need to have real numbers and real money to have real data. And we've built a glide path that really maximizes allocations to private markets during the early to mid career phases so plan participants can harness the power of compounding. Those exposures then taper off as people approach retirement. And I think what's most important here is that everything has to be centered on age appropriate risks. So when we think about those core menu options, I do think we're going to continue to focus on target date funds.
Yes, that makes sense. And I appreciate the age appropriate risk as well, because I'm having different conversations with both my wealth advisor and my retirement plan advisor at 62 now than I was at 32, certainly, right? Thanks for tuning in to Grade to Great. I hope you're walking away with a few new ideas, a few bold strategies, and a bit more fuel to take your business further than ever. If you found today's conversation valuable, make sure to subscribe, leave a review, and share this episode with a colleague. The best way to stay sharp is to keep learning together. So I'll see you next time right here where we will cut through the noise to bring you what really matters. Until then, keep pushing forward because there's no gray area in achieving success.